Casey Scott, and I'm here with Graham Wickham, President and CEO of Wickham Financial and Insurance Services. And, we had a kind of a roller coaster week last week after a hotter than expected inflation report. Graham, what can you tell us about that?
Yeah, you're absolutely right. We saw the fifth largest intraday bullish reversal in the S&P in history on Thursday. I think it was like about a 6-7% swing from lows to the high, and I think we closed up at least up on the Dow somewhere around 800 points. So just some volatility, right? And it's all being spurred on by the anticipation of higher inflation and the Fed having to be more aggressive for longer to tap down high inflation, and the fear that it could be pushing us into a recession, maybe a deeper one than originally thought. So we saw the NASDAQ off about 3% last week, really driven by technology with those inflation fears. We saw the S&P, Russell off somewhere around 1.5%. Only 3 of the 11 S&P sectors even had a gain. Where we did see a gain, though, in consumer staples, healthcare, financials. Financials saw a lift last week. We had JP Morgan, Wells Fargo, and others come out and show relatively, strong numbers in comparison to maybe what was thought. Crude oil tumbled a pretty good bit off of some continued fear of maybe a deepening recession that might damper demand for that good. We're looking at 2-year yields shot up to about 4.5%. That's the highest since we've seen since 2007. Where we saw the CPI, and that's where we mentioned earlier, we saw the CPI, the Consumer Price Index, heat up, increased to about 0.4% month over month, and about 8.2% year over year, with really some of the biggest jumps we saw in that sticky food prices, right? It's just not coming down where we would like it, and even plateauing. We just need that to kind of plateau and start to come down, and I think that would give this market a lot of solace. We did see internationally, we saw just continued turbulence internationally with the UK making some reversal in some of their previous expectations with policy. We saw China consumer prices increase about 2.8%. We've had some rolling shutdowns in China. We've had some real estate issues, really some growth issues in China. But we are seeing some inflation increase over there. But this one kind of hit home, I think, for everyone. The IMF lowered their global growth estimates and predicted that much of the world would be in a recession in 2023. So we're really seeing a shift from, well, maybe we're seeing a recession this year, to maybe it's going to be pushed off to a bit of maybe the first quarter of 2023.
Okay. Well, I know we're getting close to that time of the year when we start talking about the Santa Claus rally.
Right.
Are you getting geared up for that right now?
You mean with the white beard? I'm just going to say that's an elder state of my life right now. It used to be brown, and now it's white. But yeah, let's get geared up for the Santa Claus rally. That's a great segue in. That's traditionally a pretty strong time in the market. You never know exactly when it's going to start or how it's going to start and all that. But usually it starts around, I would say this time or a little bit later part or November, last all the way into June or right after tax time. And that's a very powerful time. Portfolios have to do what's called window dressing, and a lot of pension funds have to invest money via mandates they have inside the portfolio, among other factors. So let's get geared up and see what that looks like this year, especially if we go into a Santa Claus rally being down. That might set us up for maybe some positive returns.
All right. I was going to ask, if this trend is still intact, what do you think needs to happen in order to start an uptrend?
Well, like I mentioned just a minute ago, we have to see some consumer price plateauing, right? We're starting to see a little bit of crack here in rents. Maybe plateauing and coming down a bit. We need to continue to see housing prices come down. We need to see unemployment go up. And I know this is, counter to what you would think. You want bad news would actually be good news right now. We need wages to come down. We are seeing a little bit of that. So I think when the Fed blinks, right? They talk about a pivot, forget about the pivot. Just talk about blinking. If the Fed blinks and said they maybe don't have to be as aggressive, I think that could buoy this market, and you might really see a huge rally. We just got to see when that's going to happen. And since we don't know exactly when that's going to happen, we just have to stay invested, right? Stay diversified, stay with high quality investments in your portfolio, keep some extra cash on the sidelines. Bonds are looking much more attractive these days than they used to. So that can play a bigger role in a portfolio where we really haven't been making big recommendations in bonds in previous years.
Right. Okay. Well, lots to think about. And thank you so much, Graham, for that. And thank you to our viewers for joining us today. And we will look forward to seeing you again next week for our next weekly wrap up. And in the meantime, hope everybody just has a great week and enjoys the fall. Thanks so much.
Take care.